People are always wondering what they should invest in. So I think this will be a good one. Welcome to the Matt Money Show. I'm your host, Matt Cervoni, a CPA who likes to talk. And my goal is to provide clear steps to take control of your business and personal finance. If you have topics or questions you'd like addressed on the show, go to @the Matt Money Show on Instagram, leave a comment, or send us a DM. And since we're talking about investing in this episode, I do need to say this podcast is for informational and educational purposes only. It is not intended as financial investment, tax, or legal advice. Investing involves risk, including possible loss of principal. Always do your own research and consult with a qualified professional before making investment decisions. One other reminder is that we have a link tree set up on @the Matt Money Show on Instagram. And on that link tree, you can get a discount on Monarch Money, which is a great budgeting tool. And I think I'm actually going to also add the Wealth Front for high yield savings. So you can get like a 1% boost on your initial cash deposits, as well as like a little bit higher investment return over the first 3 months. And then it'll average out with the way the market goes. So check those out and let us know if you're looking for more resources we could possibly add. So today we're going to talk about what should I invest in. I think this is like a really common question. Once you get your cash flow right and you do have some money where you can set it aside, that becomes like, okay, yeah, cool. What do I do now? It's almost like going to the gym. And if you're not like a fitness enthusiast, you're like, okay, I made it to the gym, but like, what am I supposed to pick? And so you're in the right place. It's now just time to figure out how to optimize it. And it's funny, in the disclaimer, this is just like a legal thing. We talk about always consult an investment professional. Remember that we don't necessarily need a professional early on. What we need to do is create good money habits. And if we become wealthy in the future and we get to a certain level of complexity or of wealth where we need the advice, that's when those people are going to come in and really add value. So I would say early on, do not outsource this. There's a great quote. I read this in a book. His name is Jim Rohn, I believe. And the quote goes, "Don't wish it was easier. Wish you were better. Don't wish for less problems. Wish for more skills." So what we're going to start with is 3 simple questions. Number 1, what are we actually saving for? And most people are saving for at least 2 things. One being retirement, and the other being short-term needs, such as like a vacation, maybe you're looking to buy a new vehicle, whatever it is. We're at least saving for those 2 things the majority of the time. Now, there could be other goals in mind. You may be saving for down payment on a house. You may be hoping to retire early, in which case a retirement account is only going to be available to you in those retirement years. And so when we think about, what to invest in, we need to start with that question. Secondly, when will we need the money? So, for example, in an emergency fund, we don't know when we need the money. So it may need to be more considered short term because at any moment something could happen. Whereas if we're investing for retirement, we're essentially leaving that money alone until we're 60 years old. And then we would consider our options at that point. So that's question number 2. Now, question number 3 is one that I think is unique to the Matt Money system. And that is, what is our interests? This is something that I've found interesting over the last 10 years of really studying personal finance in my own life and in the lives of others, is that we are typically just geared to do better in things that we're interested in. So I think the same would go for investing. If I'm very interested in real estate, then I think I will receive the best returns and do the best from an investment standpoint by going down that road. Whereas if I really don't like houses at all, and real estate sounds flashy, but seems like a lot of work, this is not going to be a good area for you. So that's just a mini example, but where our interests lie is going to be not only a big motivator, but is going to naturally help us become better educated because we're more interested in those topics, and then obviously do better. So let's start with the what are we saving for? So what are we saving for if it's short-term needs? What we would mostly want to do is save in a high-yield savings account. The reason for this is twofold. Number 1, in a high-yield savings, the money is available to you for withdrawal. Worst case scenario, it's going to be like a couple of business days to receive the money. Best case scenario, I know this is true for my Wealthfront account. There are a few like instant transfers. So if I like really needed to grab money to, let's say, pay for an emergency, that money could be there as soon as like 5 minutes. So that's one thing that the high yield savings really is advantageous to. Whereas if I invest in stocks, that's pretty instant as well. But definitely where if I'm investing in like real estate or a small business, there is that money is tied up, is not available to me should I have an emergency. Now, the second thing is not only the timeliness that we could get the money, but what are the tax effects going to be of taking the money out? So in the real estate or in the stocks example, by taking the money out, I might owe taxes on that. Whereas in my high yield savings account, I owe taxes on the interest that account earns. And I'm going to settle that up when I file my tax return every year in tax season. But the principal amount or whatever I withdraw does not have any tax consequences. So it wins on both fronts. Number one, the money is readily available to us. And number two, we don't experience the tax effects that we might in other investment types. So from things like a vacation, an emergency fund, and maybe saving up for a car or down payment, those are common things that best case scenario would be in a high yield savings. Keep it simple. Your 3 to 4% interest that you're earning on that is great, but we're not trying to beat the market here. We just need our money to be available to us and earn some sort of a return. So we're happy with that. If it's for short term and if it is something that we're saving for that is in the relatively like near future, we want it to be there. And remember, from Matt Money System, we have categories in our high yield savings. So we can name them like vacation, car savings, down payment savings. And that's a good way to stay on track. Now, what about retirement investing? Because that's the second thing that I mentioned is very common and almost everyone is going to have at least some short-term savings and retirement. So retirement investing, I believe, should be done with, if you're going for a traditional retirement, which is like retiring around age 60, maybe slightly later than that, then I believe in traditional investments. And that would be things like mutual funds, stocks, and now index funds as well. And the big advantage to these types of investments are they're completely passive. So you don't have to think about them or even manage them from a day-to-day basis. Think about index funds and mutual funds as a way of putting your money into a business without having to come up with the idea for what the business is going to be. And you get the benefit of diversification. So, if I wanted to put my retirement savings in a stock, let's just use an example of like Blockbuster, that would have been very detrimental. And I would have had to make that decision, which requires some work. And Blockbuster is no longer in business, so my retirement savings would not have done well. Whereas in the index funds and in the mutual funds, yes, there are some companies that don't necessarily perform very well or maybe fall out of the fund. But the companies that are successful remain and they remain strong, which helps you average out an overall market return. So if you're looking for a long-term investment, such as retirement savings, and you don't need the money soon, and you want it to be passive, then I think index funds and mutual funds are the place to be. Now, what if I'm not interested in investing at all? And I want it to be completely passive, but I'm doing great on my retirement savings. Maybe like, okay, I want to retire early. I want to have access to my money before age 60. That's okay too. I'd still recommend maxing out your Roth IRA at a minimum if you're eligible. But in the same vein, you can invest in a brokerage account, which is a type of investment account where think it's the same as your retirement account. You just don't receive any tax benefits, but in exchange, you don't have any restrictions. So if you're really good at saving money and you want to invest in index funds in a brokerage account, you could theoretically get to a certain level of wealth before retirement age and live on the passive income that portfolio brings. It'd be a very patient strategy, but a very cool and safe way to retire early. So you could have that going for you plus the retirement account. So we've kind of covered what's common. So short term, what if I'm not interested in investing, or what if I'm just looking more long term? But what if I am very interested in investing and I'm ambitious and this is something that I truly enjoy? I want to educate myself. Well, now we open the door to things like real estate or individual stocks or even small business ownership, which is another form of investing, because most of the time it's our time and effort, but sometimes it is a capital influx to the business. And in all of these worlds, we are still investing, but I want to make it very clear without going too much into the nitty gritty of the differences between these. You are going to have to do some level of work. Commonly, we hear that rental properties, I think this is the one that sticks out above all, is that they are these completely passive investment vehicles that provide a monthly cash flow. You basically just take your rent, subtract out the mortgage, and that's the money we get every month. And I would just be here to tell you that if you have not experienced rental real estate, I would not have that be your expectation. Even if you have a property manager, even if you buy great properties, there is going to be some level of work that you'll have to do, and you'll have to pay attention. So look, if you're really not interested in real estate and you think it's going to be a quick couple of years, I get my rental properties and I'm living, financially free, I get passive income every month, that will most likely not be your experience with these. So make sure you're interested in them. But if you love real estate, or if you've always wanted to try your hand at small business ownership, I think these are great places to invest your money and your effort. Just know the difference between them and the index funds, which essentially automate your investing journey. Now, you'll notice I didn't mention crypto, and I also don't mention here speculative stock picking. And that's because in both cases, oftentimes you're sort of rolling the dice. And I know there's probably crypto nerds out there that would argue with me on this. I'd be happy to have a further discussion with those people. But essentially, when you're randomly picking a stock, or you feel strongly about a certain cryptocurrency and you see that as an investment for your money, I am here to tell you that is essentially betting. And as someone who lives in Kentucky, in Lexington, Kentucky, we have Keeneland right around the corner, and it is a lot more fun to to bet your money at Keeneland than on a stock that you read about, in Wall Street Journal or in a cryptocurrency. That's just my opinion. You may have a difference there on what's most fun to bet on, but crypto and individual stock picking, those are bets. Those are not investments, and so we should treat them as such. Betting is not advised. Now, we did have one question from the last week's episode, which was Matt Money System, our personal flow. And this comes from Jane, actually. So Jane asked about why I use 2 credit cards instead of just one. And the reason for the second credit card is so that we can better distinguish credit card 1 being our regular monthly expenses. Groceries, any utilities that we can put on the credit card, the stuff that's going to go into our budget. Credit card 2 is actually for the expenses that we're going to reimburse using our high yield savings. So this would be credit card 2 would be great to be like a travel points credit card, where you actually get a reward for going on a vacation and buying a flight. So think about what you typically are saving up for in that high yield savings, and maybe match a credit card to those activities. But ultimately, it is just for simplicity. You could do this with one credit card if you're very organized, but in my experience doing this, it's been the most easy to have them separated. And that way I can see very clearly, what do I need to reimburse through my high yield savings and what is going into my regular monthly budget. So you guys have been great. Again, I love the support, and keep asking questions, and I will see you all next week.